If you have traded equities for the least amount of time, chances are that you might have heard the saying at least once, sell in May and go away. It's become a trading urban legend at this point, but does it hold any weight when put to the test, and more importantly, could you derive or enhance your trading edge from it? Well, I guess there's only one way to find out. As always, this kind of work wouldn't be credible if I did not disclose the analysis method that I used. Obviously, in order to determine whether sell in May and go away actually is a superior way of filtering out the seasonality of the US stock market, we first have to define what that is. Sell in May and go away means selling at the end of April and buying back at the beginning of November, essentially remaining invested in the winter and staying out in the summer. With most studies that you will find about this phenomenon out there, the calculation is always hyper-focused on the rate of return or probabilities of winning, which is typical of how people at large view performance. And so this type of generic analysis seeks to cater to their basic understanding of finance. For example, if you stumble upon the study published by Investopedia, you will see that it revolves around comparing equity curves, i.e. cumulative returns. The problem is that this is very surface-level analysis that does not even begin to describe the true picture of the sell-in-May bias. Chances are that both of these curves would overlap if we normalize risk for return or return for risk. And that is the extra mile that we're going to go today. We'll be looking at actual performance, meaning risk-adjusted return ratios only. In order to do so, we'll be standardizing those compounded annual growth rates with respect to two different metrics of risk. The first metric is the maximum drawdown ever observed during the study period. That will give us our typical MAR ratio. The second one will describe our systematic drawdown, which we define as the mean between the average and the median incremental drawdowns. That will give us what we will arbitrarily call here our systematic MAR ratio. I will also be using monthly data points as increments for this analysis. Going monthly instead of weekly or daily is expected to remove some granularity, but the conclusion will remain just as relevant since we're going for ratios. Now, note that I focused on three critical study periods describing the behavior of the S&P 500 index. The first one being since 1929 to encompass as much reliable data as possible, the second one being since 1988 to isolate the introduction of electronic futures, and the last one being since 2001 to isolate the transition from fractional to decimal-based quotes for US stocks. And here are the ratios and the improvement margin of sell in May and go away versus passive investing. As you can see, the aggregate edge of plus 13.1% that is combining the performance adjusted for both maximum and systematic risks is somewhat present if we start in 1929. However, decay and inconsistency are showing afterwards. The edge is ebbing and becoming quasi-non-existent down to a mere plus 1.7% if we start in 1988, only to jump back to plus 9% if we start the study in 2001. Clearly, that is anecdotal and way too erratic to be exploited in a quantitative strategy, and frankly, that is not really surprising. My subscribers know how many times I have urged them to be very wary of so-called edges that are only statistical, meaning that can only be demonstrated through local occurrence or correlation as opposed to absolute mathematical causation. And to the untrained eye, the result that we are getting here appears to be edge decay over time, but this is not even decay that we are observing. It is just that there was never any edge to start with in the first place, including since 1929. We only witnessed a statistical artifact. True edges never decay because true edges belong to the construct of price formation itself. For those of you who have more of a visual way to understand concepts, let me show you how the illusion of returns can blur your perception of actual performance. Let's take the 1988 chart for example. In blue, you can see the equity curve of the S&P 500 index under passive investing, and in red, the same chart but filtered for the sell in May scheme. The primary reaction that you may have is that visually, the passive investing scheme looks better. Why? Because of the final returns. Now look at both equity curves, but this time comparing apples to apples by normalizing for risk. I think this picture speaks 1,000 words. Does it look like there is any remaining edge left to you? Get the point? Alright, moving on. Now to further drive the validity of those ratios home, for those of you who still believe that there is some relevance to be attached to the sell in May phenomenon, I went ahead and combed two of my flagship systems through this seasonal filter, namely Gamma RSV and Gamma HFT. I wanted to compare leaving them on all the time and turning them off between the end of April and the start of November, and once again, compare the risk-adjusted returns. In order to be conservative and give the selling May edge even more chance of working, I made sure that these systems are opposite in style and both of them cannot at the same time benefit from this phenomenon, should it actually be exploitable. That way, each system had a chance to demonstrate that the edge existed even if the other one didn't. That is why the first system, RSV, is a trend following systems rebalanced on a monthly basis, and the second system, HFT, is a swing trading system rebalanced daily. You can find more information about the core algorithm that powers all of these systems on my website if you're interested, and no, they are not for sale. So what are we getting? Are we improving these systems' performance in any way? Well, actually not. In fact, we absolutely nuked them. As you can see, the edge for RSV has decreased by a whopping minus 23.5% and minus 30.4% respectively since 1988 and 2001, and that of HFT has also drastically been reduced by minus 25.1% and minus 30.4% again for the same periods. This should not be a surprise for any serious quant developer. Why? Because there is such a thing as adding too many cooks in the kitchen when building a system. Stacking edges can definitely become counterproductive. However, here, there is no conundrum to be solved since we already showed that no selling May edge was to be had in the first place. The reason why the filtering result is so dismal is because the systems themselves are meant to tackle all market conditions without any bias, arbitrarily sampling a subsection of the market to apply them to, even by using a mere seasonal filter, will not keep them from being profitable, but will necessarily also create a counterproductive bias. So this result is absolutely expected and should be construed as a sign of algorithmic robustness. In fact, I'd be freaking out if I saw their edge take off when sampling them to only 6 months out in a year. So there you have it, short and sweet, yet another market myth busted, and more time freed up to focus on what matters. Remain locked in on math, guys. Not bro science, not correlation, not statistics, not chart reading, not drawing lines, and even less so on woo-woo new age trading psychology. This game is all about math and nothing but math. I'll see you in the next one.